So now, forecasting Amazon stock-based compensation, we're going to be taking line items on the Amazon's income statements that are subject to stock-based compensation. So in this case, we will grab those operating expenses on Amazon's income statement. So in this case, except cost of sales. So we believe that Amazon might have stock-based compensation on its fulfillment expenses. So we have that in place. We could also grab other items on Amazon's income statement. So we also believe that Amazon might have compensations, stock-based compensations on the marketing department. So they might receive stock-based compensations. We also believe that technology and content, the department may also receive stock-based compensation. And also general and administrative expenses, so that the administrative department may be subject to stock-based compensation. So all of these are a function of Amazon stock-based compensation. And also we have other operating expenses might also be a function of stock-based compensation. So we have all of those there. So we can multiply that by the average of the stock-based compensation in the historic period, which we calculated a while ago. So we have the assumptions here in our control panel tab. So that's how we project Amazon stock-based compensation for each period. So this later one, we kick into the additional paid in capital, which we're going to be calculating later on year in the balance sheet. So the stock-based compensations will impact the additional paid in capital in the stockholders' equity side of the balance sheet later on. So we have that in place now. And then for other non-cash expenses net, so here we have to offset those changes in marketable securities, which we already determined a while ago. From the operating expenses part of the income statement. So we have those changes in marketable securities here. So we have to offset that amount for other non-cash expenses as such. And then for the inventories, account receivable, accounts payable, accrued expenses, and on-end revenue, all of these are non-cash items, which we have to offset this with the net income that is generated in the period. So we're going to take these changes from the balance sheet. So it's going to be equal to, we go to the balance sheet, grab the changes in inventory, and also we also grab the changes in account receivable, which is just one cell below inventory. We can feed that with Control D. So we can see that there is an increase in inventory, which is a cash outflow. So we have to make sure that we make this a cash outflow. And then we have cash that is being tied in account receivable because there was an increase, so it's also a cash outflow. So we have to make sure that we make that a negative. And then for accounts payable, it's going to be a separate line item. So we grab that from the liability side of the balance sheet where we have the accounts payable. We take the difference between the current period and the prior period. So there is an increase in accounts payable, which is a cash inflow. So we are essentially saying here is that Amazon is actually having cost savings by having an increase in accounts payable as a result. So there is cash that has been tied in accounts payable, and that makes it an investment kind of a strategy for Amazon that is borrowing from its investors as a result of that. So we can look at that accounts payable like that. We can copy that formula for the accrued expenses and unearned revenue. So we have those in place there. So to account for the net cash provided or used in operating activities, we can